Alrighty, folks, I know you were going to wait. I know you guys didn't go anywhere. It's too exciting. We know this. It's Chaz Guinn from Revolve Capital, good friend and colleague of mine, and he's dropping nuggets like he always does. And we were just talking about before the break, folks, you can be an investor and learn all this, become a professional note investor. There are educational places out there. We all have them. Noteinvestoruniversity.com. Go there, check it out, right? I mean, there's tons of places where you can get educated. So you can get educated and then be the man, the woman, be the pro. And you're buying notes, you're holding notes, you're managing those notes, and you're doing all of that. And it's much more passive it can be than being a landlord and other type of investment vehicles. Nothing's really passive, folks. You're going to have to, manage your portfolio, do asset management, keep up with your servicing company and so forth when you own the notes. When you invest into a fund, maybe like Revolve Capital, then it is really, really passive. It is really passive, isn't it? And then, Chaz, he goes, no, but I can do both things for you. Don't worry. Revolve's got you back. If somebody wants to be the pro, you can buy a note from Revolve, right? Revolve will sell a one-off note to a note investor. If you want to own one in your portfolio, you can get access to notes and buy them from Chaz's group at Revolve. Also, you can invest into the Revolve fund, and you can be very, very passive and let their team do what they do best and what they have a track record of doing for many years, right? So Revolve does sell notes to note buyers. What does that look like?
That's what we've been doing for 15 years. Is prior to coming to market with this available fund that folks can invest into now, that's giving out quarterly distributions between 8 to 10%, determining how much you invest. But it also is allowing a 50-50 waterfall after we wind down the 3-year allocation of the fund, which how that translates is roughly to a 20 to 22% annual targeted return. And so today we've seen a lot of our folks bifurcate and hedge their strategy. We've seen them invest passively into our fund and also actively invest into buying their own potential cash flow plays or even fix and flip plays. A lot of our buyers have said, hey, look, I've got enough cash to put into your fund, but can I also come to you and still buy onesie twosies that are right in my backyard? And I said, absolutely, right? A lot of folks that we sell to say, look, we like the mailbox money and we're investing into your fund because we like the mailbox money position it brings us. But also we want to stay busy, right? We're retired. We sold our business. We're traveling. We want some stuff to kind of keep us busy and to do on a more consistent basis. So imagine the fund is able to get a significant discount because it's taking down product like a Costco does. And then it can turn around and show you individual onesie twosies that may be right in your own investment background and backyard, I should say.
Yep.
So they can do both. So I'm also allowing folks to have a passive investment vehicle to work alongside us. Also, we're still maintaining our active platform that we've had for the better part of the last 15 years. Today, Patrick, we support over 1,000 buyers, and that number grows monthly because it organically is coming in. Because what we've noticed is that we've got a big Northeast focus. We've got a big Southeast focus. We've got a West Coast focus. And folks that are on the West Coast may not like product that's on the East Coast. So we cater, right, to a little bit of a different buying investment criteria. And that's why we constantly are showing out product. It's for folks, we came across a lot of folks, Patrick, they're like, hey, I've got no interest in putting my money passively somewhere. I'm an active guy or gal. We want to get our sleeves, we want to roll up our sleeves and get dirty. Perfect. Come be a buyer on our platform, show up monthly, and we're going to show you product on a consistent basis. And they're like, fantastic, right? So a little bit of kind of best of both worlds for our audience.
Yeah, it's a beautiful thing, right? You're trying to make sure that you have a place for everybody and how you can accommodate them. And that's an awesome thing. Let's talk a little bit real quick, Chaz, about, you talked about, the 2008 to 2012, we'll call the golden era of note investing. May I don't know, maybe never see that kind of thing again. Who knows? Maybe we will. But obviously the mortgage meltdown was a scenario that was a pretty impactful scenario for the world as a whole, for the economy, and for people. And unfortunately, when there's blood in the streets, there's opportunity. And there was a lot of non-performing debt being sold at that time at pennies on the dollar. And ye who was ready, educated, prepared, set up to absorb that at that time A lot of people became very wealthy off that opportunity. Now, let's talk about the opportunity where it's gone to now. We still say, Chaz, that even though this is such a great opportunity, there's so many savvy investors that don't even know that it exists still. It's still like such a small little niche investment vehicle, right? What do you see now? I heard you say it's starting to pick up again or something like that, right? So what do you see as current market conditions now? How's the note space working now? And then what do you think? I know you don't have a crystal ball and you're not a magic genie, but what do you see in the next, say, 3 to 5 years for this note space? Is it too late for people to get in? Is there still a huge opportunity? Help me elaborate on that.
I know how many times we've all seen Shark Tank. Folks go on there and tell how big the market cap is and why investors should get into the sunglass arena because it's a $3 billion market cap, right? Why don't we take that same analogy and apply it to the audience here? So we all know that it's not '08, but what this market will look like over the next 1 to 3 years will be its cousin. It won't be its brother or sister, but you can tell they are related. Okay. And what that means is we saw from a data perspective, we always say internally that facts tell, but stories sell. So when we look at the facts, we can see that in the height of '08, '09, 2010, mortgage delinquency nationally rose up to double figures, 12 to 13% mortgage delinquency across all books. Okay. Today, in contrast, the today delinquent mortgage book sits at 3% across all mortgage markets. Okay. Today, there's roughly about 55 million active mortgages that are available today. It's in the trillions in terms of market value. Okay. So if you guys just did 3% of trillions, right? You're going to see that today's available delinquent mortgage balance today is sitting roughly between 250 to 300 billion of available properties that are 12 months or more delinquent. Let's root into this a little bit further. There was roughly 750,000 homes that were 12 to 24 months delinquent on payments pre-COVID. One more time, 750,000 units 12 months or more delinquent pre-COVID, okay? What we've seen is when we were in the middle of COVID, as we all heard the fancy term forbearance agreement, 1 out of every 2 government-backed loans was put into a forbearance agreement. Of those 1 out of every 2, guess what? 60% of those went into default, okay? So I'm looking at a 750,000 pre-COVID mortgage book. Now I'm looking at another 600,000 units at a minimum that will be added to that 750 now that we are post-moratorium and foreclosure releases and eviction releases. Okay, so I'm looking at a market cap of about 1.5 million units today that are sitting between 12 to 2 years delinquent, 12 months to 2 years delinquent on payment. And we're even going into a rising interest rate, rising market. Now, again, I don't think it'll be a sharp decline like it was in '08. But I don't think it's going to be as a soft of a landing like everybody is predicting. They are feeling like it's going to be a mild recession. They are predicting a little bit more of a softer landing. I do not feel that certain markets throughout the country all will be hit the same. There was an article that Goldman Sachs just put out that says that Austin, Scottsdale, Arizona, and certain parts of Florida are going to have a similar '08 crash. And you're like, wow. But they also had a similar HPA, home price appreciation incline, that was almost unfounded, right? The data really didn't support the double-digit appreciation numbers those markets continue to feel, right? So sticking to the market conditions, we feel like today's market, although is nothing like it was 15 years ago, is still going to be frothy. I think the delinquencies today that sit around 3% will spike to around 4 to 4.25. I don't think it'll get silly. But when you mentioned when I start seeing an uptick, it's because even a 1% uptick in the mortgage delinquency market will bring thousands of more units to the private sector. And that's why we're starting to see an uptick in volume.
Yeah. And, guys, again, it's like, I say that a little analogy for folks, Chaz, that I like to use, but it's about, when it starts to rain heavy with opportunity, and you're caught standing out there just getting drenched, but you don't have any buckets to put out, you ain't ready to collect. So I'm like, that's why, folks, is there opportunity still left in the note space? Heck yes. Is there still going to be some major opportunity in the note space over the next 3, 5, maybe even 10 years? Absolutely. Is there maybe going to be a time where we see it start raining again? Maybe not same as '08, but maybe it's cousin, like Chaz is saying, right? The cousin of '08, where there's just massive opportunity in the note space. Well, what are your buckets in the note space? Well, education bucket. Are you got the education out of the way? Do you know what you're doing? Get that out of the way as fast as possible, folks. Understand this note space and really learn what it is, because then you're going to need to be prepared. You're going to have to make connections. It's a people business. You're going to have your people. You're going to have your vendors. You're going to have your connections. You're going to have it all in place. Now you got buckets. When it starts to pour down money, you're prepared, and you can actually put buckets out and catch all the rain, right? So yes, there's mad opportunity left. Chaz agrees. And I love it. I love it. And that's why we're teaching more and more people. Get into the space. There's going to be so many notes available. You're not going to impede on our inventory, Chaz, right? If we train somebody new to be a pro in this space, there's plenty of notes to go around, guys. Plenty, and more to come, just like Chaz is saying, from all the forbearances. And because the large funds haven't made much movement, right, Chaz? The big players been on hold for 1.5 years, 2 years. Can't do any foreclosures. Can't do any evictions. What do you do to move on your portfolio at that point, right?
And what were they doing as they were sitting back, right? Not moving their portfolio because of moratoriums. They were sitting back and collecting payoffs because the refinances were booming because rates were artificially put lower, right? And because the rates have been so artificially low, and you were at a 6% rate from 2017 or 16, and now you refinance to a 3.25. What you did is, even though you were not making your payment for the last 12 months, you just paid off your lender. Boom, refinance, paid off. What about the second alternative that big shops have been doing as well? Is the delinquent homeowner was just sticking a for sale sign in his front yard and selling his property for above asking, and then paying off the lender that way. So those two major alternative strategies that homeowners that in delinquency have been using to their advantage, do you think they're going to be using those over the next 1 to 3 years, as rates are as high as they are and as low as demand is for housing, right? Because right now, even if you want to buy a house, are you going out and getting a 7.5% rate? You're not jumping into that market. So that's why we foresee that big sellers that have not been selling are going to start coming to market selling because of major issues. They're not going to be getting payoffs both from refinances and home sales.
Amen, brother. I love it. All right, guys. Well, there's opportunity to be had. We're going to take another quick commercial break. These wise and kind words from our sponsors, we got to let them in. So just don't go anywhere, because I'm going to be right back with Chaz Guinn from Revolve Capital. See you in a minute.